You've switched to oat milk, you recycle, and you haven't printed an email since 2012. But your pension's funding oil giants and weapons manufacturers. Bit awkward, isn't it? Today we're unpacking the buzzwords ESG, SRI, and impact investing, and asking, are these funds really doing good or just good at marketing? Hi, I'm Alefa, Chartered Financial Planner, and in this video we'll be discussing ethical investing. What is it? Does it work? Is it smart finance or just smart marketing? Before we kick off, could you do me a quick favour? Hit the subscribe button and support our growing channel. So what is ESG and friends? So a quick glossary, because these three terms get thrown around like they mean the same thing, but they're actually quite different. So ESG stands for environmental, social, governance. Environmental. How much of a mess are you making? It asks how well a company tackles its environmental footprint. Are you burning fossil fuels or switching to renewables? How are you handling your waste? And what are your plans for climate change? Social. How do you treat your people? Are your workers paid fairly? Is there a diverse and inclusive culture? And how do you treat your factory workers overseas? And governance. Who's steering the ship? Is there a diverse, accountable board? Do executives take responsibility when things go wrong? And are decisions being made in shareholders' long-term interest? Think of it as a risk management filter. Companies are scored on how well they handle issues like climate change, employee treatment, and ethical leadership. SRI stands for socially responsible investing. This one's more values-driven. Investors screen out industries they find morally unacceptable to invest in. Think arms, tobacco, gambling or fossil fuels. And finally, impact investing. Here, profit is not the main driver. It's about backing businesses that actively create positive change, like clean water tech in Africa or mental health startups in the UK. Think of ESG as, is this company behaving itself? Think of SRI as, I don't want to invest in this. And think of impact investing as, I want to fix this. So why is ethical investing booming? Let's go back to 2013. A major factory in Bangladesh collapsed, Rana Plaza, killing over 1,000 employees. Brands in the West scrambled to explain how their supply chains allowed such unsafe working conditions. Among the ruins and the bodies, the labels of many Western brands were found, from Versace, Prada and Primark, to Zara, H&M and Walmart. For many investors, it was a wake-up call. Am I unknowingly funding this? Fast forward a few years and you've got school kids marching in climate protests, social media companies uncovering scandals in real time, and documentaries such as The Social Dilemma making us question whether or not Silicon Valley is really improving our lives. In the last decade, public awareness for environmental and social issues has exploded. So has the demand for investments that do more than just make money. Add in the rise of climate activism, global movements for racial and social justice, scandals from companies behaving badly, and regulatory pressures from the EU, the UK and beyond, and you've got the perfect storm for ethical investing. Trillions now sit in ESG labelled funds, but where that money goes and whether it actually does good, that's where things get murky. So what's actually in these funds? Well, let's talk about the screening process that ESG and SRI funds use to filter businesses. There are two types of screening, negative screening and positive screening. Negative screening is where a fund excludes certain companies or sectors based on things they don't want. Imagine you're planning a big family dinner. Your mum's vegetarian, your nephew's allergic to nuts, and your dad's trying to quit booze. Negative screening is like going to the supermarket where everything is available and then saying, no steak, no peanuts, no whiskey. Those are non-negotiables. It's a values-based approach. You're not trying to impress anyone, but you're just trying to make sure that no one at the table feels betrayed or harmed. Funds using this approach appeal to investors with conviction. They say, I don't care if it's profitable, I don't want my money supporting that. Positive screening is more proactive. Rather than just avoiding bad apples, it's looking for companies who are doing great things, leading on things like climate, fair wages, innovation in clean tech, or improving access to healthcare and education. Let's say your best friend's getting married and you're in charge of the playlist. You could just screen out all the bad songs that are going to kill the vibe, but that's not enough. You need to actively pick the songs that are going to make people dance. Positive screening says let's find businesses that are trying to fix the world and back them. That could be a solar panel manufacturer in Yorkshire or a fintech company tackling financial exclusion in Nairobi. This approach is often used in impact investing too, where making a difference is part of the goal, not just a bonus. In reality, many ESG funds use both. They might screen out obvious no-go sectors like tobacco or weapons, and then tilt towards companies with strong ESG scores, like those leading in clean energy, fair supply chains and inclusive hiring. But here's the catch, the criteria is not standardised. One fund's definition of ethical might include big tech companies who have brilliant governance but have questionable social impact. Another might exclude them altogether. That's why understanding screening matters. It shapes what you're investing in. Many ESG funds hold companies such as Shell, Coca-Cola or Meta, all who have complex reputations. Why? Because ESG scores are based on how well companies manage risk. A well-run oil company can still get a good ESG score, not because it's saving the planet, but because it's managing its risks responsibly. So if you're expecting ESG to align perfectly with your morals, you may well be disappointed. SRI tries a bit harder, but again, values are subjective. And impact is purer, but it's often higher risk and not always accessible. So is it all just a bit performative? Greenwashing is a real risk. Some companies slap a green label on without making any meaningful change. DWS, the asset management arm of Deutsche Bank, was caught exaggerating its green credentials. They used slick marketing to position themselves as a standout ESG company, but their internal systems didn't back this up. They lacked robust processes to actually embed ESG in their decision making. They overstated how many of their assets were actually ESG integrated. Their public statements didn't align with their actual investment practices. Essentially, DWS painted a green picture, but when the regulators looked behind the curtain, what they found was more grey. Between the US and Germany, DWS was fined €50 million, all for failing to deliver what it promised on its marketing. And some fund managers know ethical sells, so they'll rebrand an old fund with ESG and call it a day. It's a bit like slapping plant-based on a packet of oven chips. Technically not untrue, but not really groundbreaking. So does it actually all work? Many studies show ESG funds have outperformed traditional ones, especially during periods of volatility. But some of that may be due to them being overweight in big tech. Eugene Farmer and Kenneth French, two of the most influential minds in modern finance, introduced the idea that certain factors can explain why certain investments perform better than others over time. Their original model identified that smaller companies perform better than larger companies and undervalued companies perform better than overvalued companies. So what's that got to do with ESG? Well, many ESG focused portfolios unintentionally tilt towards some of these factors. So even if you strip away the ethical wrapper, there's a plausible investment case for ESG being a proxy for resilience and operational quality. Long term, companies that treat people better and the world better might just be more resilient, but there's no one size fits all, and not all ESG funds are built the same. So how can you build an ethical portfolio that's actually ethical? If you want to align your money with your values, here's a roadmap. 1. Define your values. What's important to you? Climate? Equality? Avoiding certain industries? Next, research funds. Don't rely on the label. Look at the fact sheet. Look at the top holdings. Thirdly, watch the fees. Ethical investing should not be expensive. Whilst there is some additional costs in the screening and governance, the fee should not break the bank. And finally, be realistic. You won't find a fund that's perfectly aligned to your values, but you should be able to get pretty close. Ethical investing isn't about sainthood. It's not about wearing hemp trousers and memorising the exact carbon footprint of every company in your portfolio. It's about something much simpler. Intention. It's about caring enough to ask better questions. Where's my money actually invested? What kind of companies am I backing? Intentionally or unintentionally? Does this align with my values? Or is it in direct contradiction? The truth is, you don't need to be perfect. In fact, you can't be. There's no such thing as a flawless ethical fund, because ethics themselves are not universal, they're subjective. What's right for one person may not be right for the next. But what you can do is look past the marketing spin. Read the fact sheets, yes, even the boring bits, and start making decisions that feel intentional, purposeful, conscious. Because here's the thing, your money has power. Even if it's sitting quietly in a pension fund or a passive tracker, it's still shaping the world by funding businesses, backing sectors, and signalling demand. So if you care where your money sleeps at night, it's worth lifting the lid. See what's inside. Ask the awkward questions. And if you're not sure, ask your advisor to show you where your money's really going. You might be surprised, and you might just find it's time to change. So what are your thoughts on ethical investing? Please let us know in the comments below. And if you found this video helpful, Please like, share and subscribe for more insights on building real wealth.